investors use different calculations to determine whether an investment is worth making. Here are 3 common investment calculations. Return on investment (ROI). This calculation measures the amount of return an investment generates relative to its cost. The formula is gain from investment cost of investment x 100. A higher ROI indicates a better return on the investment. Net present value (NPV). This calculation takes into account the time value of money and adjusts the expected cash inflows and outflows of an investment to their current values. The formula is sum of present value of future cash flows initial investment. A positive NPV indicates that the investment is expected to be profitable. Internal rate of return (IRR). This calculation determines the rate of return an investment is expected to generate. It is the discount rate that makes the net present value of the investment's cash flows equal to 0. The formula is NPV sum of future cash flows 1 IRR n initial investment. A higher IRR indicates a more profitable investment. Capitalization rate (cap rate). This calculation is commonly used in real estate investment and is used to determine the rate of return on a property. It is calculated by dividing the net operating income by the property value. Debt service coverage ratio (DSCR). This calculation is also commonly used in real estate investment and determines the ability of a property to generate enough income to cover its debt obligations. It is calculated by dividing the property's net operating income by its total debt service. Payback period. This calculation determines how long it will take to recoup the initial investment. It is calculated by dividing the initial investment by the expected annual cash flow. A shorter payback period indicates a more favorable investment opportunity. When considering an investment opportunity, it's important to use multiple calculations to evaluate its potential profitability and risks. No single calculation should be relied on in isolation.